When you normally hear about risk management, it's usually in the context of position sizing. Hedging provides an extra layer of safety, but in a completely different way. This past week, I used two different risk methods, and I want to talk about how you can structure your trades. On Thursday, I used a conservative hedging strategy. On Friday, I went all in. Let's see the difference. I'm in a few trades, but I want to highlight four in particular. On one of my accounts, I'm long AUD CAD and short AUD JPY. As you can see, I'm in profit on both trades. Over on the left side, the two trades I want to talk about are Euro NZD, where I'm long, and GBP NZD, where I'm short. Once again, both trades are running a profit. The price of Forex is quoted in pairs, which makes it different than trading other things. Think about Tesla or Bitcoin. If you think they're strong, you buy. If you think they're weak, you sell. Forex isn't like that. You don't buy the euro or sell the euro. What you're actually trading is the ratio of one currency versus another. You think the euro is strong, and you might be right. But if NZD is stronger, Euro NZD will actually go down. The true beauty of hedging is I don't care if a currency goes up or down. I can make money either way. Let's think about what's going on behind the scenes. When we're long AUD CAD, we want AUD to be strong and CAD to be weak. We're short AUD JPY, so that means we want AUD to be weak and JPY to be strong. On the left, we want Australian dollar to be strong. On the right, we want the Australian dollar to be weak. Therefore, we're actually neutral on Australian dollar. The same logic for NZD. On the left, we're long Euro NZD, so we want NZD to be weak. On the right, we're short GBP NZD, so we want the New Zealand dollar to be strong. We just saw that I'm indifferent what AUD or NZD does. The trick is you can't just blindly enter two opposing trades. They both have to make sense. Let's go back to the charts. I'll show you what I mean. This past Thursday, we get two sweeps of liquidity, two fair value gaps in a row, and looks like price wants to go higher. If price retraces, we can get long, targeting the recent high for 2-to-1. Here's AUD JPY. We see this high was swept, rejected, creates a fair value gap. It's come back in here twice. Each time it's provided resistance, and then yesterday, we're at the very top of this fair value gap. If we see weakness at this level again, we'd be looking to short. So on Thursday, we're starting to see price rollover. We get a wick through the fair value gap, but I want to see a body close. So we have a fair value gap below the fair value gap, stop above the daily fair value gap, and target these recent lows. Another trade we saw was long in was Euro NZD. Running a fib, we see the 618 line up right with this fair value gap. Stop below the recent low, we can target the high. And we would be long at this point. So here we had an unusually strong move. Pushed right above the highs, but can't stay above it. Got a big void here, and I think a short would be reasonable. Hopefully it's making sense how one trade can balance out another, but this is only level one. Let's see how we can build even higher. So from these four trades, two currencies we actually don't care if they go up or down. From these four trades, we have four currencies that are actually unpaired. Two we want strong, two we want weak. The question is how to hedge these other four currencies. I trade 28 currency pairs. Here are four possibilities. Each of these trades would neutralize two other currencies. So for example, these euros cancel and these GBPs cancel. Scrolling through your charts, you see a good short setup for Euro USD. Now you're neutral on Euro, but now you're strong on USD. You keep looking and you see one more good setup. You're short on USD CAD. The two USDs cancel and the two CADs cancel. Now you're neutral on both. Hedging is not only a profitable strategy, but it's a low stress way to trade. As long as my trades are structured correctly, I don't really care if a currency goes up or down. If the euro goes up here, I lose a little money, but I make even more on this trade. Hedging is great for ranging markets or when you're not exactly sure where the currency wants to go. Now, on the other hand, if you have a strong feeling a currency is either going to go up or down. You want to squeeze the most out of that move and only bet on one side of the market. As I mentioned at the beginning of the video, last Thursday I hedged my bets. On Friday, I put all my eggs in one basket. Click here to see how it went. Thanks for watching, and I'll talk to you soon.